as we've heard, the Commonwealth Bank today reported a big jump in profit in the last 6 months. Cash profit for the half, $4.7 billion. That's up 23%, as the bank impressively grew market share by 20 basis points. But its net interest margin shrank 14 basis points. And this happened like other banks because a large number of CBA customers have switched to lower margin fixed rate home loans during the period. The percentage of fixed rate loans grew from 38% to almost 50% in the space of 12 months. People clearly are fearful of rising rates. Despite this, the Commonwealth Bank still managed to pay shareholders an interim dividend of $1.75 a share and also flagged a share buyback worth $2 billion. Joining me now, the Commonwealth Bank's Chief Executive, Matt Comyn. Matt, many thanks for your time. Can I just start on that net interest margin? Clearly, while interest rates are falling and you've got customers really moving around trying to take advantage, it is a fact that there is pressure on your margins.
Yeah, thanks, Ross, and good to be with you. Yes, look, net interest margins have been under pressure really for the last few years as we've come through consistently a falling interest rate cycle, and that's weighed on in the half, as you said, in particular, that customers, quite understandably, who were becoming thoughtful about when interest rates were going to rise later this year, and we saw a big increase in interest rate expectations in Australia and internationally, and that put pressure on margins. We saw more customers switching from variable to fixed rate margins during the 6 months, as you said. Notwithstanding very strong volume growth, it did put downward pressure on margins for the period.
You've always been pretty upfront with your customers about trying to make certain they've got a buffer, trying to make certain they're protected and so forth. Though the Reserve Bank seems to give an indication that there will be no rate rises this year, it's still sticking to the program, as it were. What's your own sense about when your own customers should really become prepared for the prospect of rising rates?
I think they should definitely be thinking about it, and as we've seen many customers have in the last 6 months, our economics team believe the first cash rate increase will be in August of this year, which is clearly not too far away. We see a cash rate of about 0.75 of 1% by the end of calendar year and a little over 1% over the next 18 months or so. So not big increases in the cash rate, but for many borrowers, the first time that they will have seen actually a rising interest rate environment. And so definitely something that we've had a lot of conversations with both our personal and business customers over that period of time.
OK, one of the things about the banks and all banks is that when interest rates were falling to try and preserve margin, you didn't fully pass on Reserve Bank interest rate cuts. Now, I guess people sort of understand that. They don't really understand that. It becomes a political issue. But I'm also sensing, because the margins have now been trimmed as people have refinanced, if rates were to rise, from the book's point of view, as you try and improve these margins, you'd be less inclined to pass on a part of a rate rise. You'd be more inclined to pass on the full rate rise.
Yeah, and look, I won't speculate, Ross, as you wouldn't expect me to, about what we might do in response to, cash rate increases over time. But I would say, as you've indicated, there's a lot of downward pressure on net interest margins for financial institutions in a low rate environment. That's just a reality. That's the context that we operate in. But pleasingly, we've been able to provide substantial financial support to more than 160,000 home loan customers, 80,000 business customers, particularly through deferrals to get through the pandemic. The economy's recovered well. We've seen a pickup in credit growth, so volumes have been good. Margins have been under pressure now for some time. Now, a slightly rising interest rate environment would certainly provide some support for interest margins. There's also a lot of factors. There's competition in home lending, in business lending, in deposits. And of course, a rising interest rate environment is good news over time for depositors. They've had a very tough few years where, the interest income that you can receive on deposits is, dramatically lower than where it was sort of 3 or 5 years ago. So I guess for us, it's sort of both sides of the balance sheet, lots of different decisions that we'll make to try and deliver obviously great outcomes for our customers, but also to be able to support our shareholders. And, we've got more than 800,000 Australian households who hold us directly. And of course, the dividend, as you mentioned, of $1.75 today is good news for them.
Okay, take me to the actual housing market itself and the mortgage market. You've gained market share here, but obviously, the margins have been trimmed. What's it like out there right now in terms of the way in which customers are aggressively negotiating between banks and other lenders to try and get a better deal, or indeed, as we've seen, to fix those rates while they remain so low?
Yeah, well, I mean, first and foremost, the housing market, I think to the surprise of many, including myself, has been extremely robust over the last 18 months. We've seen strong house price increases. We saw a pickup in credit growth. There's lots of banks competing for every customer. As you said, we've done well. So we've clearly made sure we've been very competitive in trying to deliver a great customer experience. There's been a lot of price-based offers out there, particularly around for fixed rates towards the end of last year. And, as interest rate expectations were increasing, and even though there has been some increases to fixed rates, that's sort of compressed margin. So, I do think it will continue to be a competitive market. I think that's great news for customers. It's clearly critical for us to make sure that we're delivering a great proposition for our customers. I don't see that changing particularly significantly over the next 6 to 12 months. That said, I think there will be fewer customers switching to fixed, because as fixed rates have gone up, and there's probably been 5 or 6 increases in fixed rates even over the last 2 or 3 months, because there's been such a big change in interest expectations in Australia, but even more markedly in New Zealand, in the US, in Canada, UK. And so I think, there will continue to be offers out there in the market.
I'll tell you what, so much more to talk about. I could have gone to actually the way in which your staff are adapting to whether it's work at home or work in the office, and even just the changing nature of business in Australia. But we'll save that for another day. In the meantime, Matt Comyn from the Commonwealth Bank, I appreciate your time.